Hello and welcome to my Accounting 1120 discussion on investments. We're doing a little experiment here. It's late at night and I just can't seem to sleep, so I thought I'd get up and spend some time with you. You'll have to tell me how this works. I'll probably know how this works. Let's give it a go. So my goal in this pencast is to provide some very general information to you regarding investments. We'll get into the real deep parts of this chapter in other pencasts. One thing I want you to note in this chapter is we are the investor now. We've spent a lot of time being the issuer on issuing stock and the lender or the owner on issuing bonds, but now we're going to be the investor. So we're going to do accounting from the investor's perspective. So investors are going to sometimes make investments in other businesses. First of all, why would they do that? And I can give you two pretty good reasons. If you have idle cash sitting in your checking account, you could earn a higher return if you invest in another business versus just accepting whatever paltry fee the little bank's giving you. And then there's another reason, one you probably haven't thought of so much, but will become apparent when we look at certain kinds of investments. And maybe you have some strategic move that you're making with your investment. Maybe you're trying to acquire stock, and it would have to be stock because you'd want to vote and have significant influence on the person you're investing in, and if not significant influence, even controlling interests. So we'll look at that. Those are generally the two reasons people invest. What are our investment options? Well, let's put down the balance sheet equation, and for a minute, but not very long in this chapter, let's talk about the investee's books. Person that we're thinking about investing in. We can buy their bonds or we can buy their stock. They might, if we become buying their bonds, we will become a lender to them. And we'll get that cash flow we talked about in the last chapter. If we buy their stock, we become an owner. Maybe even a voting owner if we go with common stock. So they're really different kinds of investments. If we buy bonds, we're hoping for a couple things. We'd like to get our principal back. We didn't give them the money because we like them. We want it back. We want to earn interest. We want that cash flow of the bonds we looked at in the past chapter. And it wouldn't hurt us if there was an increase in the market value and we had a gain on it too. That wouldn't hurt our feelings at all. So that might be why we become a lender. Why might we become an owner? Well, or what is it we're hoping for? We're hoping to get an increase in the market value of the stock, so we get a gain. That wouldn't hurt our feelings at all. Like with the bond, and we're hoping to earn dividend revenue. So we can invest in a business's debt, or we can invest in their equities. And we'll learn some accounting for both. Now, I want to take a minute. We're through being the investors, or the investee. Come back with me now. We're still the investor. There's a lot of ways you can talk about investments. And I want to show you balance sheet categories we learned clear back in Chapter 4 when we learned how to do a classified balance sheet. And remember, there isn't anything else. We didn't learn to classify balance sheets at first in our studies of accounting because we had hard enough time learning what's on a balance sheet. We're beyond that now. And in Chapter 4, you learn to classify them. And we listed assets. And we showed current assets. And we showed the category investments. And then we showed the category plant assets. And then we had an other, where you could stick intangible assets and other things. And under liabilities, we had current liabilities. And we had long-term debt. And now we have stockholders' equity as well. And under stockholders' equity, I'm going to keep going on this because I'm going to surprise you a little bit. We have the paid in capital section where we show the stock that we've sold. We have the retained earnings section where we keep we keep our earnings we haven't paid out in dividends. If we have treasury stock, it comes off. It's an unallocated reduction on the bottom of that under the cost method. And now in this chapter, we're going to also have something called accumulated, I left part of the word off, sorry. Accumulated comprehensive income. And this is new to the chapter. And that equals our total stockholders' equity. So we've added a little bit. What I want to talk about right now is how do investments fit in this. Well, if you have an investment that you are going to convert to cash in a short period of time, you can have them classified on the balance sheet under current assets and call them short-term investments. And really, it's based on management's intent. How long are you going to hold it? If management intends to hold investments longer, you can have long-term investments. And if you're invested in bonds for the whole period the bond's outstanding, you're definitely going to be long-term, except for the year that it matures. And again, this is done on management's intent. Stock doesn't have a due date. The only way you can find out if it's short-term or long-term is to ask management. So that's how our asset side of things are going to change. And just for future contemplation, stockholders' equity is going to change too, with an account called accumulated comprehensive income. And it's a stockholders' equity account, but it can have a debit balance, meaning reducing it and acting like a contra account, or it can add to it, acting like an adjunct account. So we'll look at that while we look at investments too. Well, this is what I wanted to talk about in my really short and general overview, and it seems to have gone all right. I'm still awake. Let's keep going. Thanks for joining me.